black to now. Yeah. So again, yeah. In the last class, we have discussed about CAD budget techniques. Now we are going to discussing about um, risk analysis in capital budgeting. So here we are going to learning about what is risk in capital budgeting. So capital budgeting, nothing but capital budgeting. If the person is going to investing their investment in different portfolios, how they are going to gaining the profits, how they are going to receiving the profits. There are some techniques are there like modern and traditional techniques are there: payback period, internal rate of return, net present value, and uh, profitability index. Now we are going to see what are the risks associated. Risks are associated with the capital budgeting. So here we can see overview of risk analysis in capital budgeting. Risk analysis is in capital budgeting involves assessing the uncertainties. What are the uncertainties? Unexpected things is going to come in the capital budgeting and potential risks associated with the long-term investment decision. So potential risks, what are the potential risks that are associated with the long-term investment decisions? So since the capital budgeting projects require significant financial outlays, that's significant. So significant financial outlays and affect a company's long-term profitability. So that we have to understand and managing the risk in essentials to making sound investment choices. Now we can see that what are the important importance of risk analysis in capital budgeting. So risk analysis. So importance of risk analysis in capital budgeting, it helps in identifying potential risks that are associated with the investment projects. So what are that risks? Every project has a risk. So there's a potential risk is going to be there. So it improves the decision making by quantifying risk. So improve the decisions and making by quantifying the risks and reduce the likelihood of project failures. So this financial risk and risk is also reducing the project failures, improve the decision making by quantifying the risks, and also identifying the potential risks associated with the investment projects, and also aids in selecting projects with a best risk return balance. So it also helps in selecting the projects with a best risk return balance. and enhances investors' confidence. Now, types of types of risks in capital budgeting. So, what are the types of risks here? When you're able to see here the business risk, financial risk, operation risk, market risk, technological risk, and political risk. So, every business have what kind of basically business risk is going to be there. So that are related to market conditions, competition, and demand of fluctuations. Yes, every company, they have a business risk about their competitors. Who are the competitors? If they're going to produce a particular product, what are the demand situations, conditions in the market fluctuations? They have to understand. They have to understand. Can look about the capital marketing conditions. Now, financial risks. So it arises from funding methods such as debt financing, and also operational risk. So it involves risk related to the production process, supply chain, and labor issues in the inside of the company. So inside internally there is a risks are going to be there. That is a production process risk, supply chain, and labor issues, and market risk. So it caused by interest rates. So it depends upon, for example, today gold rates are going to be increasing and decreasing. It depends upon the market conditions. Interest rates may fluctuates. This is going to be there. Exchange rate policy and technological risk. It arises from technological changes and observances. So technology is going to be changing every day. So that kind of change also is there in the companies. Political risk. Government always interstate or else inter countries political taxation and regulations will be there. That should depends upon the government. The government will take the decision so that they have to implement it in the market or the companies or industries. Now, techniques of risk analysis and capital budgeting. What are the techniques are there? So to understand or to analyze the risk analysis. So here the sensitivity analysis is one of the technique to analyze the risk. So sensitivity. So sensitivity analysis. So sensitivity analysis, it examines how changes in key variables like sales volume, cost, or interest rates. So these are the internal variables of the company side. So that sales or cost or interest rates affect the project outcomes. It helps in identifying the most sensitive factors, project performance under different scenarios like best case, worst case, and most likely case. So it helps estimate possible variations in project outcomes. So scenario analysis. So it evaluates about the performance under different scenarios. It depends on the best case, worst case, and most likely cases. It depends upon these cases. The scenario is going to be there in the projects. One company is going to best results. One company is going to giving worst results. Some other is going to be giving likely or good. Okay, there's good number of no, no, results will be there. So depends upon that situation. The situation is going to be possible, and then they can also estimate it. and simulation analysis, that is known as also Monte Carlo simulation. Simulation analysis, Monte Carlo, both are same. So here they uses the computer models to generate thousands of possible outcomes based upon different combinations of computer models. They used to generate the thousands of combinations, and it provides a profitability distribution of potential risk returns. So the simulation analysis, when it comes to the particular person, particular activity, it provides a probability distribution of potential returns. So if the company have a potential returns, so then only that it will be calculated or analyzing it. So risk adjusted discount rate, DADR. So it applies a higher discount rate to riskier price, higher rate discount rate. So in higher discount rate to riskier product to account for an uncertainty. So why these companies are going to showing huge sales are there, and also how less price are there in the market? Why they are comparing and covering? So that the company person, they used to understand the market conditions, which is important to our hub or particular location. That is required. That is, if anything is in the old case of betas, it can, if that is going to be not um, uh, risky level, then that should be considerable. So sometimes the company has uncertainty also is there. So in account of uncertainty, the DADR, so risk adjusted discount rate will be applies in higher discount rate. And higher risk also leads to higher discount rates, lowering the present value of future cash flows. So future cash flows, how that was there, how why are that thing this are. So higher risks lead to higher risk leads to higher discount rates and lower the present value of future cash flows. So decision tree analysis. It maps out different possible investment outcomes and their associated probabilities. What are the different possible investment outcomes that they are associated with the probabilities? It helps in understanding multiple paths and outcomes of the investment. So what are that helps in understanding, and what are the multiple paths, so and outcomes of the investment? So the decision made the tree analysis is discussing about the how we can able to take the decisions without harming anyone. So in the same company, the company break even. So break even analysis determines the level of sales or promotions, what is required to the particular total cost, a total inquiry, the total uh, so it helps in identifying minimum performance required. The so break-even analysis determines the level of scale, sales of production, and that needed to cover the total cost. So total cost, what is the total cost is going to be there? with that link to the production and sales, and helps in identifying the minimum performance required to avoid the losses. So every company they have to focus upon what are the minimum performance to required to avoid the losses. That is on a break-even analysis. Example of risk analysis and capital budgeting. Scenario: a company is considering investing in a new manufacturing plant with the initial cost of rupees 50 crores. So the project is expected to generate cash flows for the next 5 years, but there are risks due to market demand fluctuations, raw material price volatility, and also competition. So what is going to be having the companies considering investing in a new manufacturing plant? So companies planning to invest in a new company, then the initial cost of capital is 50 only. So initial investment also very important thing inside your organizations. So the project is expect to generate cash flows for so the project is expected to generate good flows for the fires but there are risks due to market. What is the market here? So the project is expected to generate cash flows for the next 5 years. So next 5 years, but there are risks due to market demand fluctuations, raw material price volatility, and the competition. So we have to understand that what is the competitor, who are the competitors to us, and what are the marketing, raw material, demand fluctuations, etc. We have to consider. We have to see. We have to look up that conditions wise. So this should we have to understand by these examples. Now, let's see in the step one, the base case analysis without risk consideration, assuming expected annual cash flows for first 5 years, 10 year, first year 10 year, second year 12 year, third year 15 year, fourth year 18 year, and for 5 years 20 year. So using discount rate of 10%, the net present value NPV is calculated as. So how to calculate that? Net present value is going to be calculated. Now see, using the discount rate of return 10%, NPV net present value is calculated. There is a formula is there, that is NPV is called sigma E C T by 1 plus power of T minus C0. So CT is called cash inflow in the period T, and R is equal to discount rate, that is required of return. That means of how much we want, maybe 10%, 12%, 30%. That is official. So in the unofficial cases are is that rent maybe certain. The income maybe keep it side. So T is equal to so R is equal to discount rate referring the rate of return. Right. Now T is equal cash inflow, cash inflow, and CO is equal to So this is the formula. So for that, we have to look about where we have to get the judgment. So the below problem after so after discounting the present value, the pi CR is a profit of positive. So the price seems viable, acceptable. How the cash flow in is equal to T and discounted required reversion and now see the case sensitivity analysis in the step 2. So impact of key variables on net present value. So we test how changes in key factors affect net present value. So when we see that factors, sales price, sales value, and raw material, so how much that were changed, increased or decreased? So change is there on all sales price and sales volumes are into negative, and only raw material costs will be increased plus value. So when come to calculate the net present value in terms of crores, 2 CR will come in the first 2 CR, that is here. Addition. So when you take decision, you must have an idea about investment decision factors. So you can see, go back also. So 2 CR net present value and minus so negative sales price. So negative sales price is nothing but minus negative 10%. And a new net present 2 CR is still viable. And sales value the 15% change is there, even negative. Now, the case of sales value, there is a change of minus 50% and net present value minus 3 crores, completely risky process. And the raw material cost. Raw material cost is 20% plus, that means a positive value is there. Even that is neutral value, 1 CR is there in case of raw material. So here there is no risk. So simply low risk is going to be there. So if sales value would drop by 15%, the product may not be profitable. So sales volume is completely down 15%. So that there is the risk is going to be there. So that may not be profitable. If raw material cost increase by 20%, the raw material cost increase by 20%, the product remains low risk. Nothing will be there because that risk manufacturing cost is going to be increased. At the same time, sales price may be increased. So sensitive analysis shows that demand fluctuations are the biggest risk. So sensitive analysis shows that demand fluctuations are the biggest risk. So in the case of 3 scenario analysis, best case versus worst case, let's see what is the best case, what is the worst case. So in the case of best case, this is the cash flows per year. There is a positive value 20% higher and the net present value 2 volts here, and highly profitable. So highly uh, possible. In the case of here cash flows, so what is the best case and worst case during the the situation? We can able to see that in the best case example, positive value is higher. That is net present value towards here, and it is highly profitable because there is no negativity. There is no negative value in the net present value. In the case of worst case, minus or else negative 20%. So worst case, minus 20% is cash flows, and the net present value also minus 5 CR is there. So here we can reject because even at least one value must be positive. So here the worst case is going to be rejecting. That is the reason here. And in a worst case scenario, the net present value becomes negative minus 5 CR, meaning that project will result in losses. So we can understand that that is going to be results in the losses. So in the best case scenario, net present value increased significantly, making it to a highly profitable investment. In the best case scenario, net present value increased significantly, making it a highly profitable investment. So another case, risk 4 is there. That is risk adjusted discount rate. So the step 4, since the project has high demand, demand, uncertainty, the company increased the discount rate from 10% to 12%. And with the highest discount rate, net present value drops to 2 CR, indicating lower profitability but still a positive return. Now, decision tree analysis. So far, we have discussed about the risk-adjusted discount rate, RADR. So since the product has a high demand uncertainty and the company increased the discount rate from 10% to 12%. So high demand is there. That means from 10 to 12% is increased. It means there is a demand is going to be there. So that we understand that this demand is going to be increasing. With a higher discount rate, the present value drops to CR, indicating the lower profitability, but still a positive return. So if there is a return, there is a profits are down, means that is not viable or rejected. That can be also continued because there is a positive results even there. If there is a negative returns are there, then we can stop that investment, or else we can transfer or we can shift to other properties. Decision tree analysis. So if the market demand grows, the company can expand and earn additional revenue, that is high NPV. If demand declines, the company may abandon the project early, reducing losses. This analysis helps in contingency planning, example existing strategy. So when you're going to taking decisions, so the depends on the market demand, how that is going to growing, the company can expand and the additional revenue, or if there is any kind of high net present values are there. So that we have to understand, we can see in that angle. The demand declines, the company may abandon the project early. So what happened if the demand declines? Then why company has going to be accepting the project early under additional losses? How that is going to be changing? So this analysis helps in a contingency planning. Example existing strategy. So when come to the final decision, based upon the sensitivity and the scenario analysis, the company identifies sales value as the most critical risk factor. So what is the sales value is the most critical factor in these two cases, especially in the case of sensitive and the scenario analysis. To mitigate the risk, they decide to start with lower production capacity and scale up if demand increases. So they mitigate the risk. They decide to start with a lower production capacity and a scale of demand increase. And since net present value is still positive under reasonable risk adjusted, reasonable risk adjusted conditions, the project is approved with a controlled expansion strategy. So net present value always still positive, that we have to see reasonable risk adjusted conditions. So then the project is approved or not with a controlled expansion strategy. So key takeaways. Risk factors like market demand and cost inflation have significant impact on net present value. And sensitive analysis helps in identifying the most critical risk. So what is the most critical risk that we have to understand, we can see. So scenario analysis ensures preparedness for both best and the worst outcomes. So what okay, if the scenario analysis, it ensures preparedness for both best and worst cases, worst outcomes that we can understand, and adjusting the discount rate accounts for higher uncertainty. So what is the higher uncertainty? That is a scenario analysis. So adjusting the discount rate accounts for higher uncertainty. So when you talk about adjusting discount rate, then again some other situation time may not come to understand the proper scenario analysis. So the preparedness both best uncertainties and the risks. So So sensitive analysis helps in identifying the most critical risks. If any case of uh, you know preparedness, the more critical risks is, then the sensitive analysis helps in the identifying the most critical risk cases. And adjusting the discount rate, sorry, scenario analysis. So in the scenario analysis, um, it ensures the preparedness for both best and worst outcomes. So adjusting the discount rate accounts for higher and uncertainty. So adjusting the discount, the rates accounts for higher and uncertainty, and using decision tree analysis, the company adopts a flexible strategy. How that flexibility is going to be there, and the decision tree analysis. Risk analysis in capital budgeting is essential to make informed investment decisions and maximize returns while minimizing uncertainties. Minimizing the uncertainties. So by applying various risk evaluation techniques, the business can better understand and potential risks and select parts that align with their financial goals. So how we are going to apply the various risk evaluation techniques in the business that can be better understand and potential risk and selecting the products that align with the financial goals. Now you're able to see another black. So now so far we have completed black 2. Now come to the back block 3. So here when unit 7, 8, 9, 10 are there. That is in 7 is source of finance. Unit 8 is the capital budgeting structures, capital structures, and 9 is cost of capital, and 10th is leverage analysis. Let's see the source of finance. So how to get the sources from the what are the sources of there in the finance? So a financial decision refers to the process by which a business determines how to raise capital to fund its operations, investments, and growth. So it is a critical aspects of financial management as it impacts the company's financial health. risk and profitability. So in the financial decisions, we can able to see that financial decision, it refers to the process by which is what is the business determines how to raise capital to fund its operations, investments, and growth. So it is a critical aspect of financial management. It is impact as it impacts the company's financial health. So whether that company is going to be their health or not in a declining stage. So whether the company has any kind of financial risk are there, whether the company has any profitability. So that is going to be look. We can now have a look about this over the financial decisions. Now, types of financial decisions or the financial decisions. So, financial decisions generally fall into three categories. That is equity financing. First one, equity financing, raising funds, issuing shares, common or preferred stock. No obligation to repay, but dilutes to ownership and control. Dilutes to ownership and control. Example: initial public offerings (IPOs). So financial decisions generally fall into three categories, that is equity financing ones. So here the raising funds by issuing shares. So if we want to raise funds, we have to issue the shares. That is a common or preferred stock. No obligations to repay. So but dilutes the ownership and controls. So initial public offerings also IPOs. That is rights issues. Now debt financing. So debt financing. Yeah, the debt financing is about borrowing funds through loans. Borrowing funds through loans. So we are collecting loans from the banks, or NBFCs, bonds, or debentures. Okay, and the interest payments are mandatory. Interest payments are mandatory, but no ownership dilution. So interest payments compulsory. If you take any loan, any borrowings are there, that we have to pay the interest. That is mandatory, but no ownership obligations or dilution. Example: bank loans and corporate bonds. So that is known as a debt financing. So in the debt financing, simply we understand the banks are going to issue the loans and corporate bonds to the companies. So the companies will take that loans or corporate bonds. They used to pay that interest that is fixed, that is mandatory for the uh, companies. Now hybrid financing, a mix of debt and equity financing. A mix of debt and equity, that is a hybrid. There is two kind of attack category of financing that is there. So a mix of debt and equity financing includes instruments like convertible debentures, preferences, etc. So hmm, right. So hybrid financing is a mix of debt and equity financing. So together. So in the case of debt, we are taking loan from the banks or else uh, issuing the corporate bonds. But in the case of equity, we are selling or we are raising the funds from the public. For that, we are offering the IPOs, initial public offerings. We are selling our shares instead of cash. We are equity shares are going to be changing. So the raising funds by issuing the shares is a common or preferred. So no obligations to repay, but dilutes ownership and control. So definitely, for example, if there's 100 shares are there, the people who purchase 500 shares, sorry, 50 shares or something. So that is going to be ownership is going to be changing. Ownership is going to be transferring. So those who have highest shares, that people are going to be having the owner or else the director company, so a major shareholder. So that's the reason we are going to issue in the IPOs in the right issues. So that is known as the hybrid financing. There is a mix of debt and equity financing. It includes instruments like convertible debentures and preference shares. So example, mezzanine financing and venture capital financing. So mezzanine financing is one kind of finance that is comes under the hybrid financing, and also venture capital funding also comes under the hybrid financing. So what are the factors affecting the financial decisions? So financial decisions that comes under cost of capital, risk and leverage, controlled considerations, market conditions, company's financial position, and the cash flow stability. So factors that affect the financial decisions. So cost of capital. Companies prefer sources with lower cost, lower cost, and risk and leverage. High debt increases financial risks. High debt increase the financial risk, and control considerations. Equity financing dilutes ownerships, and market conditions. Economic factors influence financing choices. Market conditions, economic factors influence the financing choices, and the company's financial position. The strong companies can secure better financing terms. So strong companies like Fortune 500 companies, and they secure better financing terms, that is hybrid or else debt financing or else equity financing. So cash flow stability. So firms with steady cash flows may opt for debt over equity. Now, what is the importance of the financial decisions? So here we can able to see that important factors, that is it ensures is a sufficient capital availability for the business operations. So it ensures that means that may work out on the sufficient capital availability for the particular companies or to the business operations. So balance the risks and return to maximize the shareholders value. So that balancing the risk and also returns to the maximizing. So maximize the shareholders value. That is the financial decisions. And also it helps to maintain financial flexibility and growth operations. Now see the sources of finance. So as of now we discussed about the what is one financial decisions. Now we can able to see that source of finance. So how many ways the source of finance are there? So business requires funds to various purposes such as starting operations, expanding, or managing the day-to-day expenses. The source of financing can be broadly classified into internal and external sources. So internal and external sources, nothing but that inside and outside of the business having or expanding sources, which can be uh, available to the inside and outside of the companies. So internal source of finance, yes, that we discussed just now. So internal source of finance are, so these are funds generated within the business without external borrowing. So these are the funds. That means retained earnings, division revenues, all these are the risks. So these are the funds generated with the business without external borrowing. Yes, they said that they are saying that they did bring that money uh, from from the existing sources. So what are the companies they are going to providing even the proper health skills that we have to understand. So here, so companies may understand that maybe so retained earnings. So profits are reinvested in the business instead of being distributed as dividends. So instead of dividends, they're going to receive the profits. So no interest or repayment obligations. So in the case of source of operation, uh, earlier there is a payments are there now the changed. So that means there is only one business angle is there. So here under depreciation reserves. So in case of depreciation reserves, funds set ahead from profits to replace assets over time. So it helps in maintain financial liabilities. So to see uh, external borrowing things, retained earnings, the depreciation reserve, and sale of agreements. So selling unused or absolute assets to generate funds. So short-term source of finance. So selling unused or absolute assets to generate the funds and reducing the working capital. So improving the efficiency in managing inventory and receivables and payable to free up the cash. So so reduce working capital. So reduce the capital sale of agreements and also so with this I'm stopping today. So in the next class tomorrow we'll discuss with the continuation of the external source of finance. So with this I'm stopping here. Now tomorrow we may discuss another concept and another topic. Sorry, this continuation to the this class, the next class tomorrow. So this I'm thankful to you. And,